Stop. Okay, so I think I'll be recording.
Okay, I think let's kick off. We've got a couple of people on here already. So, as I said, today's discussion is basically going to be an open forum discussion. We just want to touch on a couple of things that we saw that's happening currently with our clients in the industry, and a couple of things we want to discuss regarding impacts that it's had on our clients and also on the greater business in South Africa. So I think I'll hand over to Martin to just highlight the agenda that we're going to go through today, and then we'll kick off. But as I said, it's whenever you have a question or please raise your hand, shout out, let's have a discussion. If you don't mind just muting yourself in the interim so that we don't have any background noise. And then we'll have a chat and just brainstorm a couple of things. Martin, over to you.
Thank you, Jan, for the introduction. Guys, welcome to our discussion today. Improving profitability of trade credit sales. What a statement. What a statement. What a statement. I mean, we've gone through COVID.
Yeah.
And we're still suffering. And now last week's unrest, or the week before. And there's still some unrest continuing. And what the impact is of that. You know, some people are still battling with the first one and they're hit by the second one.
Yeah.
So I think what I've done here, Johan, is I've broken it up into two and say, what's different scenarios are at play here?
Yeah.
And each one of these scenarios, how will they impact what?
In terms of the different scenarios, we just need to discuss a couple of things that I think is prevalent to the impact of trade credit. So I think today we're going to have a chat regarding what the impact of COVID is. Let's have a chat about the riots. I mean, it's a real thing that happened and how it's impacted our clients. And then job losses that has occurred in terms of those two actions that has taken place. And then lastly, let's discuss how the risk of the debtors book of your clients has been impacted, either good or bad, in terms of the three events that has happened prior to that.
Yeah.
So, I mean, if we kick off and we talk about COVID, I think there are good and bad things that happened throughout this. And I think if I want to touch on the good things, it's probably the effect that companies have seen that, they don't have to all work at an office. They don't all have to be there. There's a lot of cost savings. I think if we look at our office here as well, there's I think maybe a tenth of the number of people that's been working here currently at the office.
Yeah.
So the cost savings in terms of the utilities, in terms of all of those things, there might be a gap. The problem with that is that the company like ours, for instance, cannot get a relief on the floor space that we've got. A lot of times you're tied into a contract.
Still got to pay for it.
Still got to pay for it. So, the rent is still there. You might get a relief and say, well, we're not going to increase the rent.
The lights must still go on.
Lights still go on. So you still pay for it. So the bad thing about, even if you're not at the office, is the company still have to foot a big bill in terms of having that space. Not they're going to be able to get out of it. And I think our CEO also indicated that it's not easy to get out of a lease or just to get a cheaper property somewhere, because the properties come at a certain floor space. The properties need to yield a certain revenue for the property owner. So it's not like you're going to be able to pick up, cheap office space somewhere.
Yeah.
So that is an issue that, although you're now sitting with this big building or this big space, you don't have people filling it, and the people are working from home.
Yeah.
Good thing is that people that are working from home now actually are able to be, I think, more productive. Because when you're at the office, there's a lot of interruptions. You talk to people, you get up, you go make coffee, whatever it is. You get to the office by traveling there for an hour. You get home by traveling there for an hour. The upside of that is that, when you're now working from home, although there's lots of distractions, you've got kids and you've got the dog barking, whatever. But I think the net effect is that employers are able to get a lot more out of the employees by the employees working at the office, if I can make that statement, or from home rather. Because, you log on in the morning at 7 o'clock and, you start looking at emails and you start working. And at 5 o'clock, your laptop's still on, you're still working, even beyond that sometimes, because it's easy, you walk from your bedroom or from your kitchen to the lounge and you work, So they get a lot, and I think with us as well. I mean, we've monitored this because obviously we are able to work off site, and we found that a lot of the people, if not all of them, working from home has actually been more productive than what they would have been at office.
Yeah, they have their coffee break behind the laptop.
Yeah, exactly.
Smoke breaks.
Smoke breaks. You
We're chatting about that. Can you,
Yeah.
in smoke break, people go outside to smoke. Takes them 15, 20 minutes.
Yeah.
They have 4 smokes a day. That's a lot of time.
That's a lot of time.
Now, the guy or the lady sits right behind the laptop, has a wee puff, and smoke away happily, carry on working.
Yeah.
More productive.
And I think lunch and all of those type of things. I mean, previously, when you're in office space, you know, you're working in a building, you want to try and get out just to get some fresh air somewhere for lunchtime. So a lot of times you actually force yourself to take that break of an hour or half an hour, whatever it is, just to get out. Now you don't have to do that anymore. You sit in front of your computer, you're already out, you know, so not a lot of things that you have to take off in terms of time. So I think employers are able to get a lot more out of the employees by working with. That's one good thing, I suppose, from an employer perspective, not necessarily the employee perspective, because people tend to work longer hours. And I mean, we found that from everybody that we spoke to, you tend to work a lot longer and a lot more, and a lot of times a lot more productive. You don't have those constant interruptions, unless, you know, you've got the kids running around and dog walking. But I mean, other than that, the cases of COVID, I think as of last night, there were 70,000 deaths.
70,000 deaths already.
Sure. Yeah, that's a lot. And I mean, I think worldwide we were looking at 190 odd million cases of COVID. So yes, there's a huge effect that has had. But I think the majority of the first world countries, if you can refer to them as that, has now had the COVID jab, and, you know, the people are going to move around. You know, if you watch the sport events on the TV and whatever, people are not wearing masks in certain instances because they've had the jab. Although you still can get the COVID, you just probably won't have those, you know, side effects and heavily ill state. But yeah, I mean, with the rollout of the jabs here in South Africa, a lot more people are signing up for that. And I think once the majority of those age groups has gone through, we'll have a lot easier time moving around as well. And we'll get to, you know, some sort of state of normality, if you want to refer to it as that, eventually as well.
And you know what, Johan, thinking about what COVID has done and business-wise, the good thing that COVID has done, it has sifted out a little bit of these guys that was just making it there in the business world. They've all of a sudden not recovered, and they've fallen by the wayside. So they've been taken out of the game, and it's the real go-getters that are still sitting there and going for it. But it's put a lot of focus on a lot of businesses that wanted to remain in business to make sure how they stay in business. And it's put a lot of pressure on people. But the view of how we view this is changed as well.
Yeah, you know, COVID's been a terrible thing. I don't think anybody can say it's been a great thing, but there has come some good out of it, as you mentioned. But for the majority of it, you know, people have been impacted negatively in terms of job losses. If you look at the number of job losses in South Africa only, I mean, it's in excess of 2 million, was it?
Yeah, it's close to that. And those are only the formal job losses that you're talking about. What about the guys that are standing on the street corner that are not allowed to sell there anymore? The informal employed.
Exactly. And coupled with that, you know, the revenue that was generated and the tax that was generated for the government to collect is obviously a lot less. So you've got the effect of a lot less people having to be able to contribute to the fiscus in terms of tax and pay. So, you know, for that to have a downturn, and then for the government to come up and say, we're going to add more money and provide more for our people, they're going to have to go and borrow that somewhere. And the more you borrow, obviously, you know, the worse the interest current account looks. And not just the interest, but the higher interest, because we've been downgraded as well. So all of that obviously has a negative impact where the taxpayers can have to foot that bill eventually somewhere. You know, they get it from somewhere, whether it's through the fuel price or whether it's through VAT increase or whatever it is. That's where the issues come in.
But you talk about job losses, Johan. There is so many people that are still employed, but businesses to survive, they started cutting salaries.
Yeah.
So they said to the guys, okay, we can still give you a job, but you're going to have it at 20%, 40% less than what you were earning. And that's also got a tax implication. So revenue as used to earning a 40% more tax on what you used to get, and they now have to face that as well. So the few taxpayers that are left are now going to even be more burdened.
Yeah, and I've got a lot of friends, and they're in a position where they've got a choice. You can either still continue to do this job, but we're going to pay you less. It's the exact same job, we're going to pay you less, or you can go and find another job. I mean,
or even worse, they say, Johan, we unfortunately had to let Martin go. You're going to earn 40% less, and you're going to do Martin's job.
Yeah.
So now, how do you face that? And you think, dear Lord, and then you think, must I do this? Or how am I going to do that? At the end of the day, a lot of people just have to accept that, because if they don't, they're going to be one of the statistics.
100%. And I think anybody that's got a job, even if your employer comes back and says, look, we're going to have to cut your salary and you're going to have to take on additional functions, it's not going to be a case of where you're going to be able to be in a position to say, no, I don't want this job. You're going to hang on to whatever the job is.
Yeah.
Yes, in the interim, you can perhaps look for something else, but jobs are so scarce out there. And there's so many educated and well-experienced people who haven't got a job at this stage, and it's just...
And it's not just South Africa. I mean, if you look at the statistics, the European GDP, European zone, was affected with a negative 13%. 13%. People think, oh, here in South Africa, things are bad. 13% is a massive knock on a GDP.
In China, which is probably the biggest in the world in terms of the GDP, has gone down 4.5%.
And America has doubled that.
Yeah.
Minus 9%.
And that's just the impact of COVID. People think, yes, COVID is fine and COVID is just restricted to us. It is not. It is a global thing that has affected everybody equally. We're all in this. Yes, it's bad. It's not that one person suffering is more than the others. Everybody's struggling. Everybody's got it bad. We're all in this. So, to give you those figures in terms of the Eurozone, in terms of China and America, everybody, the superpowers going down in the GDP.
Absolutely.
Gives you an indication if those guys are struggling, what's the real struggle that we perhaps are not seeing in South Africa?
Yeah. And I mean, what we're saying is in a normal recession, it just talks about the economy that contracts.
Yeah.
So there's just certain people that are suffering a little bit. But in a case like this, countries shut down completely. So it's not just a contraction, it's a complete standstill. So that's where the major impact is happening. And I think, and that's my personal opinion, we are only seeing the tail of this. And a little bit, it's still going to come big time to us.
Yeah, I think, if we look at the number of companies that went into business rescue, into liquidations from last year to this year, I think the effect is still going to be ramped up.
Oh yes,
because the company still had some sort of relief. You can still claim from the government in some respects if your business has struggled, but it's not going to make up what you lost in profits. It's not going to make up what you lost in turnover or job losses for your staff. So I think you're right. The tail end is probably still coming, where companies are going to be heavily affected in terms of what has happened. And to that extent, talking about how a country and companies. If we look at the riots that has just happened a week or a couple of weeks ago, I mean, what a scary scenario.
You know what that cost? In 1 week, more businesses were damaged, completely destroyed,
burned down,
than what happened in COVID.
Yeah.
It is a disaster, and it was very concentrated in very specific areas.
Yeah.
Can you now imagine those communities immediately around those areas? One person representing a family who had a job, had a specific small SME business, and now that business is destroyed. So that person is now unemployed, or hasn't got a job and can't feed the people that are dependent on it.
Exactly. I think something like 40,000 companies were affected in terms of complete shutdown or loss of business totally. I mean, if you think of 40,000 businesses and say they employ 50 people on average.
Take it one person per business. That's 40,000 people.
Yeah, and that one person per business is now responsible for a family of 5 to feed them. Where are you looking at those numbers? And that's one person per business.
Now you're at 250,000 of people that are affected immediately.
Yeah. And whether it's been coordinated or whether it's been planned, I think that the relevance here is the fact that it's been impacted in communities, in businesses, in industries so heavily that huge job losses are on the cards for that as well, because the company is burned down, the staff cannot go and work, they cannot earn an income, and there they sit, they have to provide for their family. So the effect that COVID has had on the one side of job losses, people who still had jobs and those businesses are burned down now, what do you say now?
You see, and the next question that you have is, so now some of these malls have been destroyed and companies can't immediately go back and start trading again. So the property owners must first fix this building. That's another 2 months delay. Then the guy can only come back and start his business again. Is he going to be able to do that?
And it's not just, a isolation of a building or a sort of a property. We're talking about malls. We're talking about 161 different malls that were looted. That's an entire mall. You know how many companies or businesses are in that mall? So it is a massive thing.
And a lot of SMEs, because you usually have the anchor store, like one of these big chain stores that acts as the anchor. And that draws these little stores around it. A barber shop, a shoe shop, a coffee shop, and all of those little ones have now been impacted.
They're talking about 150,000 job losses or affected by the looting alone. And if you take the impact of COVID, as we've all been sick and tired of talking about COVID, job losses, they now put the riots on top of it with another 150,000 jobs at risk. That's huge.
Now we're talking risk, Johan. People have ring-fenced their debt from the COVID period, and they were busy paying this off, and they were like just surviving. And here come the riots. And now their business suffers even more. So now these credit suppliers or credit vendors, the people that supply goods or services on credit, it has now got a second impact. A new arrangement has to be made. And how do you view this? How do you look at this risk, or how do you assess this risk? And where do you put yourself? Do you want to help this SME or small business to survive, and maybe not even just small business, it could be large businesses as well? How do you assist them? How do you help them work through this process, or do you just pull the plug?
And I mean, you're right. If I took a debtor on and I was happy with the risk event of that debtor, that certainly would not be the case as a result of COVID or riots as well, because now that business might have been impacted to such an extent where he's not a good risk anymore. And that's not due to necessarily his fault of not paying his debt. It's just due to his inability to be able to service that debt. So if you want to continue trading with that customer, now you have to look at, you are more on risk, but are you going to trade through this? Are you going to help the guy, or are you going to pull the plug? If you pull the plug and everybody else does, you know what happens? The business goes under. It's as simple as that. So the impact of that, and if you think about credit insurance, for instance, if you have credit insurance on your book, and all of a sudden in a position where the debtor cannot pay you, he's been impacted by COVID, or he's been impacted by the riot, whatever it is, and he has insurance. The insurance companies have to be notified at 60 days overdue. That's it. Irrespective of what happens, they have to be notified. You have to stop trading. So that's your terms and conditions of your policy that states you need to do that. The insurance company then has to take the stance and say, right, are we going to trade through or help this guy trade through, or are we going to liquidate the business? I mean, they are sitting with a massive job on their hands to decide which ones are really just not going to be able to pay and which ones are just impacted by certain events. Because you, as a policy holder, you're going to get 80% of your debt back. You might lose your GP, and that would be fine for you, but the business is probably going to close down if they pay you out, because once they pay it out, they need to recover that money from the debtor, and he's not going to be in a position to do that unless it takes him another year to trade. So is the insurance companies going to carry that on their books? Are they going to say, right, we're going to do this? If you think of the numbers that we threw around in number of businesses, I mean, we're talking about the impact of just the riots of 200 billion,
as Rand Merchant Banker said. But the question is, what about the guys that don't got credit insurance? So how are they going to mitigate their risk? How are they going to decide? Gone are the days where we opened an account on a bank code A, B, or C, and 3 good trade.
We'll talk about bank codes just now.
And boom, Bob's your uncle, and we go and we trade and give the guy 100,000, and they have to go lucky. Now you've got to be smart about how you assess your risk, and where is your risk, and what is your risk.
Exactly. The impact of people having security with their debt, when they securitize and say, we've got a mortgage bond on the property, for instance. That property is now burned down. What do you do now? There's your security. It's not because the debtors actually said, well, I'm going to pull back the actual mortgage bond or the notarial bond that you've got on my goods. Those things are burned down to the ground. Your security means zip, means nothing. So you're now in a position that if you do not have credit insurance, if you've got any form of other security, be it a personal surety, be it notarial bond or a
property bond,
what do you do with that now? It's gone.
It's with that.
So now your impact on this data would be that I've been able to supply this data based on the security that I've got. That security is now gone. Am I going to continue to supply that data? Because he's always been paying well. There's been no issues. He's been a perfect debtor. It's just my security is no longer there. Now I have to assess that risk differently because I've got nothing to fall back on. Should this guy go under, there's no property, there's no stock, there's nothing I can fall back onto. I now need to look at this debt and say, am I going to take the risk? If I don't have credit insurance, what do you do?
Even if you have a session of book debt, you cede your debtors to me, and your debtors have all been hit by this because you've been concentrating in the KwaZulu-Natal area or in the Gauteng area where the riots had a huge impact.
If your concentration risk was bad, that debtors book means nothing to you now.
And you know what? We catch ourselves, most businesses in South Africa are in the 80-20 scenario, where 20% of their debtors control 80% of their value. And if that 20%, and even in the 20%, you have 2 or 3 debtors that makes up the majority of that. And if they are in that focused area where you have had all your eggs in that one basket, you are going to be impacted dramatically. Dramatically.
I wonder if there's anybody, maybe somebody on the audience here, who has had a turn that their DSOs has actually gotten better, and not gotten worse because of some events. And I mean, if you think about it, the only way I can think of my DSOs getting better in this scenario is if I've culled a lot of my debtors on my book, if they're no longer on my book. If the bad ones that were there are no longer on my books, so my turnover would have reduced, which my profit would have reduced as well, but my DSOs are better. That's not necessarily a good thing for the overall business because you're making less profit. But the companies that are on your books now are actually paying you because they are in a position that they can. They've gone through COVID successfully, and they're actually now able to pay you a lot better. A lot of people don't use, maybe they do still use COVID as an event, saying, COVID has hit us hard, we can't pay on time. I think those companies are probably fallen by the wayside by now, and the debtors you've got on your books really should be able to pay you on time. Because everybody cannot keep on using COVID indefinitely going forward. Yes, there's been an impact on it where you couldn't pay.
Except if you're in alcohol.
If you're in alcohol, we're struggling. Everybody's struggling. But I think the fact that companies, and I'm not sure whether DSOs has actually decreased. What we've seen is that it's actually ramped up, that it's actually gone worse.
Because people give extended terms. They're trying to help their debtors to recover. You're almost getting into a situation where you got to go beyond that. You got to understand your debtor's data to see how he will be able to collect, and then that will be able to pay you. So your securities are almost going to extend to the furthest part of where the risk is lying. And if you are supplying someone that supplies the consumer, how are you going to do that? I mean, it just grows and grows and grows. So there's now things that you are going to look at, securities that haven't been spoken about in many years, like seeding of a contract, seeding of a specific project, or things like that. Those are the kind of securities that people are going to have to start looking at to make sure that they are going to help their debtors survive, and in that same process, they're going to survive.
I think that the problem with that is that I'm not sure if, and I'm going to say this probably with a lot of backlash, that the modern credit person is necessarily aware of all the different types of securities that are available. We've gone through various forms of credit, whether it being insurance or with the bureau or as a credit manager. And if you've been in the game for a long time, you have a good idea of what securities are available. But I'm not sure that, these days people look at a debt and look at the debt and say, well, this is the credit report perhaps, and this is the credit score, be that as it may. Am I going to look further in terms of security on this, and what type of securities I can get on that? And I think that's perhaps something that we need to brainstorm at a later stage as well, and just have a little session of what types of securities are available, and how you actually effectively be able to use that. Because the olden days, you would look at a credit report and you would look at a bank code, and if the bank code was bad, you wouldn't do the business, irrespective of what everything else is. These days, bank codes are falling away in any event. So you are now forced to look at all the other aspects of a credit report, interpret that correctly, and get to an answer. And not only that, if you're not happy with it, you need to take security and be able to identify what security is about. And I think
and understand the value of that security. I mean, the analytics that you have to put into those kind of things. I mean, credit insurance is almost a very straightforward product. You engage with a credit insurer via a broker or via straight with a credit insurer. You get a certain percentage. There's certain rules that you got to abide by. And if you do that, then you're secure. As you just said just now, if you take a bond over a property's values fluctuate. You take an arterial bond, someone steals the stock, it's gone. A personal surety,
not really sure.
You've got to understand the guy's personal assets and liabilities very clearly to be able to make an assessment whether that person's security is still worth something. Just this morning, still someone asked me, why did you score this business a 6? And I look at it and I say, the guy is in the ARD registration process. So, I mean, that is a very, very significant impact. The guy, SIP-C, who is way behind in their admin, have gone in a deregistration process with this guy because their own admin is not up to date. So they're deregistering the business, which means your contract becomes invalid, your invoice becomes invalid, you can't take legal action against it.
You can't claim against it.
And those are an additional risk that you now have. So if you don't keep focus on that, so the more information you have around your debtor today, the closer you live to them, the better I probably think your assessment of the risk that you're going to have is.
I think people need to probably start assessing risk differently to, I think, what they were used to. Because pre-COVID, everything was fine. You get a credit report, you get a bank code, hunky-dory, and you open the account. A lot of those things are not available anymore. So you are forced to now look at risk in a different way. And as you rightly said, not only look at the data, but look at that company's debtors if you're able to. And I mean, it's not always you're not always able to want to take a debtor on board and say, show me your debtors because I want to see who you sell to if they're able to pay you.
They're going to think you want to steal, you want to cut me out as the middleman.
It's very difficult to get that sense of it, to see how he's going to be paid and to see what terms he extended. But I mean, simple questions you can ask him in relation to that is, what terms do you give your debtors? That's an indication of, if he says I only run a 60-day or only a 30-day book, then you've got a sort of an understanding in terms of when he's going to be able to get his cash.
Correct.
If an extension takes place on his side and he only runs a 60-day book, it goes to 90 days. That means that if you give him 30-day terms, he's always going to struggle because he's only going to get his cash in at 60 days. And at best on time, if not, it's going to go over to 90 days. So those simple things, I think, if you look at it that way, when extending credit to a debtor and just asking a couple of questions, do you own the property, for instance? If you own the property, that's a little bit more security. How much stock do you carry? Things like that. It's not necessarily financial indications that it's going to give you because, sometimes depending on the amount you open up, you would want financial statements, you would want management accounts or bank statements in order to assess the risk. But without getting those, there are still other questions you can ask to get an indication of the healthiness of his business.
Absolutely. I think we're almost going to get back to the days where people have a very close personal relationship with their debtor. We almost go to his premises and say, hello, Johan, how are you today? Your business are looking thriving. It's not that I'm talking to you on the phone. I'm actually there to see what's going on and understanding that the product that I'm supplying to you, or the services or the raw material, is actually being converted. It's not lying there and rusting.
100%.
There is something happening at this.
And that says a lot. I mean, if you want to go back to, call it the old school way of doing business, when we assessed risk, whether it was with an insurance company and you had to do a buyer's visit, at a certain point when the debt became big enough, a buyer's visit is warranted where the actual credit manager has to go out and visit that debtor. And I understand that there's COVID regulations these days, but you can still get in your car, you can still get to the business, you can still have a chat to the guy outside of the premises and have a look around, see if the equipment is running, see if the machinery is running, see if there's things happening there. That gives you a sense of, I don't have to be worried about this. You know, if he's got a lot of machines just standing there and there's no people walking around, and you know you extended on a big amount here, there's a worrying side. So I think, you know, even if it's just a salesperson going out, and, you know, nothing against salespeople, but from a salesperson going to see a customer and wanting to do a assessment, or for a credit people going there, it's not really the same. Salesperson goes there and thinks, you know, I'm going to want to sell more to this guy, and he looks fantastic, and tells that to credit. When the credit manager gets there, you know, the guy's only running 3 days of the week, and the salesperson happened to be there the day that he's running. So,
correct.
You know, you have to get a credit view on it, and to get in your car and drive there. I know it's a schlep, but that's the only way that these days you're going to be able to still get that sense of, is the debtor actually fine? Is he still going well? You know, you talk to him over the phone, and you do a bank check, and you do a credit report, and everything on paper looks fine, but, you know, everything on paper is not necessarily always the way it goes. Look at our Springboks, for instance. On paper, they look fantastic, and look what happened with the rugby. But anyway, I'm just saying that, you know, get to the debtor, engage with the debtor, and you're right, go and do that visit. You know, have a chat to him and see, you know, what does his order book look like? You know, is he doing fine? Is he selling? You know, are the people paying him? Because that is going to be worth a lot more to you than actually just looking at a credit report or looking at a piece of paper and saying, well, this debtor is fine. Because the net effect is that you opened the account for this debtor. You brought him on as a debtor. Way back way, you know, maybe even before COVID or during COVID, that risk is guaranteed to not be the same anymore.
It has changed.
Fundamentally.
You just spoke about the rugby. I'm not a sports analyst, but just what you just said, listen to what you said. The Springboks went in there with a game plan, and the Lions came with a game plan. And the Springboks all of a sudden realized that their game plan is not working, and they lost a little bit of focus. And in that period, they got nailed. So exactly the same in business. All of a sudden, the game plan has changed. The risk levels have changed. The way you look at risk has changed. Do not hang on to the old way of looking at risk. You're going to burn your fingers.
It is important because, you know, if I think about assessing risk, as I said, you know, 20 years ago, and I had a bad bank code, I would not do the business. These days, a bank code is like, maybe not. Even if I don't have a bank code, I'll still do the business. So you have to shift your focus in terms of what you're looking at on risk.
Yes.
And in terms of that, you know, you have to have your data, you have to have your information, you have to do that analytics in terms of looking at what it is that you've got and assessing the data based on what you have and not based on what you don't. You know, a long time ago when I worked at an insurance company, I was always taught that if you're assessing a risk, look at the information you do have rather than what you don't have. The information you do have will always give you an answer. Even if that answer is no, it's still an answer. But you cannot use the fact that you don't have something as an answer, if you understand what I'm saying.
Even if you give me less.
Even if you give me less. I can give you less because I don't have this. Get me this and I can get you more. But you have to be able to look at what it is that you do have and make the assessment on that. Because that's the only way you're going to extend the credit.
And businesses will have to become more vigilant around that. And also the sales teams to say, guys, even if the debtors say to you, I will go and buy from X, he's going to take X. He's going to cost them money. You stick to your rules and make sure that you have used all the information, all the analytics, all the supporting stuff that you can lay your hands on to make that decision. Give him something, start trading with him, feel comfortable, increase it, and you know what that relationship builds slowly but surely. And now you start getting confidence in one another.
Exactly.
Him as your debtor, you as his supplier, and because you are so close to the debtor, you know, the human being is a strange thing. They like that one-on-one support.
Like the interaction.
Correct. So if you give him that personal attention and say, listen, I don't have enough information. I'm going to give you 5,000. I'm going to give you 10,000. I want to help you. I want you to trade. I want you to become better. And then next month, and the next month, and the next month, it grows from 10 to 12 to 15 to 20. And eventually, this guy becomes one of your best debtors. And you have a brilliant relationship.
100%. I mean, I think that personal relationship has gone, and I think it's something that people need to start getting back, because that's the only way. You know, a lot of people still want to see you, still want to sit across the table from you. I mean, here we are having a chat, and it's all virtual. You know, something that we haven't done 2 years ago because it was never necessary. You could go and sit in front of a couple of people and brainstorm.
We would have arranged a conference and a conference venue.
All of those things. So I think to get to the risk side of it, if you're looking at what things you are able to look at in terms of assessing that risk, if you're looking at the data, as I said, and analyze it properly, if you know what to look at rather than what is not there, then you can still get that decision. If you're able to, as we previously said, look at what securities are available, if it is necessary to take security, look at insurance available as well. Obviously, there's a couple of insurance, credit insurance companies, so they are able to give you a shine away from certain industries, from certain exposures, but you can still get insurance. It is expensive, but it gives you that comfort of, okay, I've got enough information that will satisfy the risk that I want to take, and the rest I've got insurance on. You don't always have to extend only what the insurance company says. You can make a call on it if you're able to assess the information and analyze it properly.
But there are professional people that, when it comes to insurance, people are always scaly. They think, oh, I can't trust insurance. There's brokers that understand these things. They can give you professional advice around this kind of thing and say to you, yes, do this or do that, or don't do this or don't do that, because they also have your interest at heart. And in the end of the day, you become one of their clients, and it's going to be important for them to build that relationship with you as well. And as you make your debtor grow and you slowly but surely walk that path with him, that trust becomes like a bond between you. It becomes a family trust. I know of companies that have been supported by the same debtor, buying from them year in and year out for years on end. Why? It's because that personal relationship. They'll tell you, oh, I know the managing director, it's Mr. So-and-so. He's been to my premises, and it's almost like that family thing. It's that bond that they have with people. And everybody, it doesn't necessarily mean the CEO of the car must get into his car and go and drive to that person's business, but it's that relationship that they have with may it be sales, may it be the credit person, but also within the business, your sales and credit people must talk to one another, because if they don't, they're going to miss that risk completely. But you know what, if you talk about bringing a new debtor on, it is important to understand how he's been paying others. And I mean, there's analytics today available that can tell you, that almost predict the defaultability of this debtor, saying this could happen with this kind of
payment behavior.
Correct. So they analyze these things and they predict how he's going to respond in a normal way.
And I think it's also important to, from a credit perspective, understand what type of products is available, what is it going to cost you, what is available out there. Because a lot of times you work in an organization and you're taken over from somebody and things were done a certain way historically, and you continue to do it without having to necessarily question if there's anything else out better there in the market. Have a chat to your brokers if you have that relationship. They'll be able to tell you what is available, whether it's security or whether it's something that you can use to mitigate that risk. Whether it is a insurance company that you can use, or whether it is a credit bureau that you can use, and whether that credit bureau is able to advise you of certain, products that are available, certain securities that are available. Inquire on that, because as I said, you cannot do it.
Make use of their expertise.
Use the people. I mean, at our organization, you can get hold of us. We can give you that information. At any other bureau, I'm assuming the same will happen. Your brokers will be able to tell you that as well. And although certain people will always want to punt a certain product, with respect to the credit brokers, they want you to have credit insurance because that's where the money comes from.
Yes.
But if you have that relationship with your broker, he won't just force credit insurance down your throat. He'll say, look, credit insurance will work in this instance, but we advise you do this on the other.
Self-insurance.
Self-insurance. So there's a lot of products out there throughout the country, throughout the organization, throughout the credit field that you are able to make use of, not only to assess the risk, but then to go further and say, how am I going to review this customer? How am I going to monitor this customer? Because, as I said previously, you open up an account a year ago. That account's not the same anymore.
No.
That risk has changed. You need to be able to have an extent to monitor that data of risk changes, of payment behavior, and ensure as well that you actually do a review. I know reviews is a schlep, and every single customer we speak to and we ask them, Do you do annual reviews on your
No,
customers?
they think you just want to make money out of us.
Exactly. But the purpose of that is not for us to make money or anybody else to make money. The purpose of that is to ensure that the risk you took on your debtor is still the same.
Correct.
For your organization, for your risk, for the extension that you have sent out, not for anybody else. Because the big thing I don't think that credit managers or credit people fully realize sometimes is that as soon as they extend credit, that is money that's actually gone out. That's gone.
They're taking your money and they're investing it in that business.
Exactly.
Whether it's in product or in service.
Exactly. I remember that, when I worked in a bank and you extend credit, there's a certain risk that you need to look at in terms of, am I going to get that back? Now, if you're working at a credit insurance company and you underwrite on a limit, you sort of don't necessarily have that sense of money is going out, because you're just underwriting a limit, and based on the information you've got, you say this company will or will not supply. That's a different way of looking at risk. Then when you sit as a credit manager and you have to give that thing away, you then realize that it is actual money going out of the office. It's gone. Then when you're working at a bureau, for instance, and you have to look at it again, you take it away from the factual thing of money is going out. Because when you're looking at data, you physically look at me and go, okay, yeah, I'll recommend this limit. You don't have that sense of the cash is gone. I must actually be able to get something back. So I think
that personal impact.
Once you start looking at what it is that you're doing on the credit side and have that sense of, if I extend this credit, it's not just a limit that I sign on, it's actual goods, it's money that's going out.
Correct.
I need to ensure that that's going to come back based on what I tell you.
Almost look at it in the way as if it is you that's taking that 100,000 and
giving it away. Would you give your own money away?
And say, I'm expecting this money to come back in 30 days.
Yeah.
Because now you still want that little bit of margin that you have. You want to protect that margin.
Exactly.
So you want to make sure that the risk is a good calculated risk.
100%.
Sometimes even a risky debtor, can I take this risk and how far can I push it? But also, Johan, that we need to understand in which geographical areas that we're going to do business.
Yeah.
So let's for instance say we're ice cream suppliers, and here comes a guy and he says, I've just opened an ice cream shop in the middle of this turmoil area. Those people don't have money to buy ice creams right now.
Yeah.
They don't even have money to buy food. So if this guy wants to buy 100,000 rands worth of ice cream from you to go and supply it there, is it going to work?
So I say, understand the debtor that you're dealing with. Ensure that you actually go out there and see this guy and visit him, because the risk is fundamentally different. When he says to you, I want a 100,000 rand limit, and you're going to extend 100,000 rand to him, and you get to his premises, and there's this small little 1 square meter place, he's not going to be able to handle 100,000. That's the problem. You don't actually do that physical visit anymore. And when you work for a finance company and you extend credit, that is a fundamental thing that they tell you to do. Always go and ensure that you visit that guy and look at his premises. Make sure that when you're there, you see the extent of the business.
Correct.
You see the extent. Is he going to be able to carry 100,000 in this business?
And the nice thing about that is you're going to eliminate these schneisters, these fraudsters.
Yeah.
Because, the other day I saw an application coming through to us for information where an accounting firm was going to buy 250,000 rands worth of tires. What is an accounting firm going to do with 250,000 rands worth of tires?
Maybe
Understand the relationship. If the company asks you for something, saying, is this a real application or is this a fraudster happening here? And if you've been to the premises, you could have understood that and you would have known what is really going on. We've got so much information available to us with Google Maps, with Google, with internet and those things. You can engage with your client and see what they are up to and what they do.
100%.
And if they don't relate to the product or the service that you render, stay away.
Also a big thing, thinking about all of these things that have happened in terms of the riots and everything else. If your debtor is selling directly to the consumer, and those consumers, by whatever means, are now impacted negatively, that debtor is not going to be able to do that anymore. If you think about the riots that are now happening, if you had a debtor in that area that was a retailer that sells directly, and his shop was totally looted, nobody's going to come and buy there. Nobody wants to get out of their houses. He's not going to make any sales. So I think the fact that you need to understand whether your debtor is selling on to other companies or whether he's selling on to actual consumers is also a big thing, because there's a huge difference in those payments. You know, if it is a cash sale and your debtor sells cash, great. But I mean, if your debtor extends credit, you need to be able to understand that, whether it's to a consumer or whether it is to a business, because extending credit to a consumer just means that you're now having to rely to that consumer, having a job, being able to get paid the same salary, not being impacted by COVID, still being able to pay all his debts, and then a nice to have debt, which is probably going to be yours on the retail side, not necessarily his utilities and his rent or his bond or anything like that. The nice to have things. So the impact of that is huge if you don't actually understand who it is that your debt is sold to.
Yeah. So we need to land.
Oh, okay.
Okay. It's nice chatting, eh?
Yeah.
But we've shared so much and we've covered a lot. Summary. Most important thing is understand who you're doing business with.
Yeah.
Be as close to them as you possibly can. Understand your securities. Understand the value of your securities. Understand how the value of your securities change on a constant basis. If it's not credit insurance. If you're looking at credit insurance, and just for those who don't know, credit insurance don't cover existing debt, only future debt.
Yeah.
So if you're looking at taking out credit insurance, remember, if you already got debt, it's not going to cover that. It's going to cover your futuristic debt.
Yeah.
But engage with someone that can give you professional advice around this.
Let me call you.
Yeah, let me call. Oh, you are. I mean, call us. We can help you. And then securities. If it is that you don't understand security, but one thing you must know about securities, it takes some time to administer.
Yeah.
You must be close to your debtor and close to your security, otherwise you lose value on it.
Sure.
Understand the regions where you are in. Understand the impact it has. Understand the debtor of your debtor.
Yeah.
Is it a cash debtor? Is it a term debtor? All of this.
100%. Okay, I think, we've talked quite a bit and we haven't had any impact from the audience. I see, Fatima, you've got your hand up. Do you want to ask something there, or you just want to try and get our attention with something?
Were you telling us?
Yeah, I'm trying to answer to Stephen's question.
Yes, who's got a question?
So he says, so very much of slow down and make a manual decision. If you have volumes of application for credit, what is panel's recommendation? And you in Oxigo leveraging data assets to assist clients. Okay.
So in terms of volumes of applications coming through, obviously we've as in Oxigo, we've got a couple of products on there. I mean, the one thing that we are busy working on and refining and actually going to have a nice launch on, I think, sometime. It's a product that we've already developed last year, and some of our clients already have that. Is we refer to it as the decision engine. So the decision engine, in short, we build a whole lot of rules based on your risk appetite, based on what you would look at on an application, and we automate that process where you would be able to put in a company, a reg number or a company name, and go through a certain process in order to get an answer like that immediately based on current information that the Bureau has. So that takes care of volumes of applications. You don't necessarily want to spend the same amount of time assessing a 5 million rand limit that what you would a 10,000 rand limit.
Yeah.
So the decision engine on our site takes care of volumes of applications. If you have an interest in that, get hold of us, get hold of Fatima, and we can show you exactly what that looks like. It's an automated product. As I said, it's hosted on our platform. You type in the name and an answer is given whether the application should be approved, should be referred, which means you need to get more information based on your rules, or whether you need to decline the application. But just want to reiterate that the rules behind the actual decision engine are your rules, what you would usually look at when you assess a.
We give them the guidelines of the rules, and they decide the weightage of each of these rules.
And in terms of getting information, Oxigo as a bureau gets information updated daily on our databases through certain aspects of a credit report. Adverse information, judgment information, SIPS information, all of that gets updated daily. So the information is pretty accurate in terms of that. And just using that, as I said previously, you don't have to look at what you don't have. Look at what you do have, and based on that, you will be able to get to an answer.
Yeah.
So that information is.
It might not always be the answer that the person on the other side wants.
But it's an answer.
I want 50,000. No, Johan, we'll give you 10,000. But let's build a relationship. Yeah. Let's work. Let's start at that, and we work from there.
Sure. Anything else?
Anybody else with any question? just while you're thinking about it, if it is that you don't want to raise your question on this platform, do feel free. You have our contact details. Send us an email or give us a call, and any one of us will assist you immediately with whatever it is that you have in your inquiry chair. If it is that you need an advice, we give advice as well.
Yeah, I mean, if you want to have a chat about certain securities that are available, and explore that a little bit, get hold of us. We're able to take you through that and give you some options. I know I said previously that you don't necessarily always think of all the options that are available, but even if it is a high risk customer, as Martin previously said, you can still do business with it by taking certain securities on it. So get in touch with us and let's have a look. I think there's a question that was just posted. Let's see what that is about. Okay, speaking about technology and data securities, right? Sure. Okay. Anything else on here? Anybody else wants to add something? Give us your opinion. I know we've talked a lot, but I mean, that's, I suppose, what we were here to do today. Anybody else want to add something to that? Your experience, perhaps your DSO is increasing or decreasing, or any comments on securities? I'm going to ask them now to do our job.
Yeah.
They don't want to do it.
All right, guys.
All right.
Thank you so much for taking the time to come and sit and listen to us today. We appreciate it.
Yeah.
We appreciate your support. We are there to support you. Please do not hesitate. Give us a call, pop us an email, pop us an SMS.
Yeah.
We will assist you.
Perfect.
Thank you. God bless. Have a great day.
Cheers, people. Go well.